Best ever listeners, welcome to the best real estate investing advice ever show. I'm Ash Patel, and I'm with today's guest, David McAlvany. David is joining us from Durango, Colorado. He is the CEO of McAlvany Financial Group, which is involved in wealth management and global real estate, as well as various other assets. David, thank you for joining us, and how are you today?
Thanks for having me. I'm doing great. Look forward to our conversation. Hope we can cover all the ground that you want to cover.
Let's get started. David, before we get started, can you give the best ever listeners a little bit more about your background and what you're focused on now?
Yeah, so our family business comes into its 50th year this year. And we started in precious metals, specifically gold and silver, in 1972. And so we have seen similar economic environments and financial market environments to what we have today. In fact, a part of the reason we exist today is because there were significant inflationary issues on investors' minds in the late 60s and early 70s. So 5 decades later, we're still doing that, helping investors who want to own physical, tangible assets. In 2008, I launched our asset management company, which focuses in a complementary way on hard assets, but this time in publicly traded markets, specifically in real estate, which would be in the form of real estate investment trusts, in infrastructure, in global natural resources, and then precious metals, but more of the producers as opposed to the physical product itself, which our sister company handles.
With the economic cycle that we're heading into now, what dissimilarities do you see versus previous inflationary times?
What dissimilarities do I see? Some of the inflationary pressures obviously will recede. It depends on the length of this pandemic / endemic with COVID, and there are clearly pressures in Chinese manufacturing, and so whether it is rare earth minerals, which are in a hard to find situation, or semiconductors, which continue to constrain some of our manufacturing here in the United States because we don't sufficiently provide our own. These are things that do have inflationary pressures which will recede. The things that I don't think will recede will be, monetary policy, which today, we're looking at changes in monetary policy, and the idea is that Jerome Powell is going to raise rates. We're going to see an increase in rates. I would just tell you that there's so much debt in the system, roughly $30 trillion, that to raise rates is highly consequential. And so being able to talk about raising rates and actually following through is quite different. So another dissimilarity is in the 1970s, as we went from the era of Arthur Burns to Paul Volcker, Volcker got to raise rates and crush inflation, right? And there we were working off a very low level of debt, private, corporate, governmental. You can't do that. You don't have the same latitude. You don't have the same levers to pull in terms of monetary policy today as you did then.
And can you dive into that a little bit deeper, where because of the amount of debt that we have, what's the impact of raising rates significantly?
Yeah, I mean, you're really talking about a cash flow issue. If you're talking about corporate entities who have a lot of debt on the balance sheet, as they recycle their debt and have to renew it, it's going to be at higher rates. So that impacts their cash flow pretty significantly. You tend to see stocks perform very well in a declining interest rate environment. And you tend to see stocks suffer, again, because the cost of capital goes up in an increasing interest rate environment. So, there's an impact to corporations managing debt maturities. There's also an impact to government itself at 2 different levels. Number one, they have to refinance their debt too, and at higher rates, it's a larger line item. Interest and principal payments become a larger line item in the national budget. If you look at interest and principal payments today, it's less than 7% of our total budget. But you don't have to add very many percentage points in terms of an increase in interest rates for that to be 20% of all government spending just to pay interest and principal. So we have a very leveraged balance sheet as a country, and an increase in interest rates takes that single line item, interest and principal, and again, from a low single digit, it could be 25% in very short order of our total governmental expenses, and that has huge implications.
And David, you keep hearing about all the money on the sidelines. What will it do to all the money on the sidelines?
Yeah, it's a good question. All the money on the sidelines, it depends on the atmosphere that you're in. Money on the sidelines in a fear-based environment stays on the sidelines. You know, the Plaza Hotel came for sale in the 1930s, and no one was willing to buy it, even though the price asked was only equivalent to the revenue generated by the bar and restaurant, not just the hotel. There's plenty of money on the sidelines, but no one would put that capital to work because they were scared out of their minds, right? Money on the sidelines in a rising market means that you're going to rise further. Money on the sidelines in a declining market means that you're going to have money on the sidelines. It's just because liquidity exists doesn't mean liquidity is flowing.
And what advice would you give to people that are going all in on real estate, taking on a lot of leverage?
Um, I think it's ill-advised for a couple reasons. You have an asset class that, like a bond, is sensitive to interest rates. You know, we've been through a good long cycle of declining interest rates. Ash, when did interest rates start to decline?
I would say 2008.
1982.
Ah,
1982. This has been this has been a huge stretch where interest rates have come down and stocks have gone in a beautiful direction for our entire lifetime. Bonds have gone in a beautiful direction our entire lifetime. Real estate has gone in a beautiful direction our entire lifetime. But the average interest rate cycle is somewhere between 22 and 36 years here in the United States. If it started in 82, we're already well past the longest interest rate cycle we've ever had, implying that at virtually zero, we have only up to go in terms of interest rates. And you're talking about an asset class that is price sensitive to a rise in rates. So if you are leveraged in an asset class that has downside potential as rates increase, I think that's a dangerous position to be in. Are there exceptions to that? Of course there are. I mean, if location is always going to be the mantra of and a true issue as it relates to real estate. Is there always going to be a place to make money in real estate? Yes, but I think you're talking about the difference between a professional and novice. If you are counting on the environment remaining the same in support of real estate trajectories continuing to go higher, again, the history of interest rates would argue otherwise.
all right. So us real estate guys, we live in this bubble where all of our news is real estate centric, our social media is real estate centric. And all you see right now is with inflation coming, how do you battle that? Go out and buy more real estate, borrow more money. So give people a little bit of a dose of reality on the drawbacks of taking on that large amount of debt. Granted, you're locked in for a long period of time, but I don't think many of us realize the pressure on the asset price itself. Can you explain that?
Yeah. So, well, and you guys know about cap rates far more than I do, but when cap rates are compressed more and more and more, another way of looking at that is the risk in the asset is also increasing at the same time. There's not a lot of room for error if you're dealing with a cap rate of 3 or 4, right? There's a lot of room for error if you're talking about a 12 cap, right? There's a lot more room for error. So at this point, like, things have to work out in a compressed cap rate environment. Things have to work just right. And I mean, I look around and I go, and I'm not a negative nutrient. I look and I say, if I can have cash or a cash equivalent and be in a position to put money to work in a distressed environment, that would be pretty compelling to me. That would be pretty compelling to me, because I think there's a lot of people in the real estate world who are way over leveraged. And if there is any change at all, either in the economy or in the direction of interest rates, you're going to find very leveraged players all of a sudden in real trouble. I mean, we've had perhaps a great demonstration of this with a Chinese development company, you know, with $300 billion in debt. Evergrande has had, I mean, they're one of the top 10 real estate developers in China. Now, all of a sudden things begin to change and there's not as many people buying apartments as there were before. So volumes changed just at the margins. And because they had so much debt, now all of a sudden they're in a real bind. They're in a real bind.
So underwriting in the perfect world, how do they anticipate what's on the horizon? Do they have their exit cap rate 1 or 2 points higher than what they're buying it at?
Yeah, that's a good question. I think a part of the question that I like the most is when you're buying something, be clear on what your exit strategy is, right? So I think that's a healthy thing to keep in mind. And if you are, again, this comes back, for me, it comes back to a compressed cap rate. If you are buying something that's at a compressed level, what possibly is your exit strategy? What
Well,
possibly exists?
I've seen a lot of pro formas where they're compressed even more upon sale.
Right. Well, but see, on Wall Street, move away from the real estate crowd. On Wall Street, we call that the greater fool theory of investing. You may come in with $10 million and all you're hoping for is that somebody comes in with 15, right? But
Right.
if you paid too much for for an asset, what you're really hoping, even though you paid too much, is that someone comes in and pays even more on the too much side of things. I mean, you're just banking on it. So what's your exit strategy? Is the best exit strategy counting on a continuation of market insanity? I don't know.
David, how do you advise people, some of the younger guys and girls that have only seen good times in their life? People that graduated high school maybe 2009, 10, and they've
Right.
had a great run, or graduated college and just all they've seen is an incredible booming economy. How do you bring them a dose of reality on what could happen?
Yeah. I mean, we spend hours every day looking at market history and looking at trends and trying to extrapolate nuggets of important data from the past that would be relevant in the present. And I think for anyone who wants to look at where we're at, it's really important that you start looking at cycles. It's really important that you understand the nature of interest rates, one of the prime drivers of real estate values. But more than that, prime drivers of all asset classes. Would it surprise you to hear that as of 2016, we're only marginally above these levels, but as of 16, interest rates hit a 5,000-year low?
That is very surprising.
Yeah. So with that in mind, you could also say that any asset that is interest rate sensitive and does well on the basis of low rates is also the equivalent of a 5,000-year high. I would just ask any investor, whether it's real estate or anything else, where do you make money? When you sell something or when you buy it?
There's both. When you buy it, it's really when you buy it.
Buy right. So
Yeah.
if we make the case that we're somewhere close to the highest values ever, because the cost of capital is the lowest in 5,000 years, you'd have to argue that you're really not, you can't possibly buy it right unless you're talking about, and that's a broad statement about an asset class in general. There'll be exceptions where the details percolate to the top, and whether it's a distressed deal or, I mean, there's always an opportunity. That makes sense. But in general, you'd say you should look at history, know where you're at in the continuum, and recognize that this is not a market that is going to help you make money. It's no different in stocks. It's no different in stocks. If you look at current price to earnings ratios, if you look at price to sales ratios, the price to sales ratio in the S&P 500 is the highest it's ever been in all of US stock market history. We blew out the 2008 levels. We blew out the 2000 levels. We blew out the bull market levels of 1968. We've blown out the levels that we saw in 1928 and 29 before the market rolled over. But so you could look at stocks and be like, my gosh, you are paying through the nose to own these companies.
I'd like to pose a couple different scenarios to you. So let's take the real estate investor syndicator who's really leveraged, taking on a lot of other people's funds as well, and interest rates go up 1 point. And now they realize their selling cap rate, their pro forma sales cap rate is not going to happen. They're underwater. How does somebody like that get right?
You get right before you get there. And you get on the hook now. You get on that immediately,
How?
because make sure that your portfolio is lightened up and you're a lot more liquid. You know,
Okay.
if you're married to your portfolio, I remember my dad sat with one of our clients, a reasonably large investor, not a syndicator, but he probably had 50 properties, single family homes, up in Oregon. And this is 2005, 2006. He sat down, did a consultation with my dad, who was in the business at the time. And he said, "What do you think I should do?" And my dad said, "I'm going to recommend something that sounds crazy to you, but I'm going to recommend that you sell 100% of your real estate portfolio." And he's like, "This is my cash flow. This is where I've made my fortune. What are you talking about?" He went home, thought about it over the weekend, and called my dad and said, I'm putting for sale signs on all the properties." That was 2006. Took him about 2 years to get liquid. The banks knew that he owned those properties, and in 2009 and 10 came to him and said, "Are you interested in any of your properties? This one's in foreclosure. This one you can buy from us in a short sale. This one," and he's like, "Wait a minute." So I got liquid in advance of a significant decline in real estate, and now I get to own the entire portfolio for cash, plus another 20 or 30 properties on top of that for cash. So he went from being leveraged to unleveraged and owning a higher percentage. I mean, sometimes the best offense is a good defense, is what I'm saying, Ash. Sometimes the best offense is a good defense. It's not as if you say, "Well, that's just silly. The sky is falling. Somebody's always betting on the downside. Yeah, there's a rain cloud somewhere, even in a blue sky day." I'm really not saying just focus on the negative. What I'm saying is be strategic in the way that you approach the markets and recognize the markets don't care about you. Markets don't care about your long-term goals or ambitions.
Yeah.
The markets just do what they do. And if there's trends that you can take advantage of, and in this case, I think you've got a lot of over-leveraged players. And I would say at this point, if you're over-leveraged in real estate, and Jerome Powell does follow through, March, April, May, June, between now and the end of the year, Goldman Sachs says we're raising interest rates 4 times this year. I personally don't believe they can do that without unhinging the economy because of our debt structures. But if they follow through, you're talking about a 100 basis point increase, to your point. Now, how does that person get out? Well, it's a lot harder to get out in December than it is now. And this is not negative commentary on real estate. This is, how do I buy more of what I own on better terms? Right? That's what I'm talking about. That's what I'm talking about.
So for somebody who's not exposed to real estate today, is there a hedge knowing that the market's going to be negative in terms of real estate pricing?
Yeah. Is there a hedge? Not a very good one, honestly. Not a very good one. I mean, that has like a direct one-to-one correlation with real estate.
Yeah. Or how can you benefit financially if you know prices are going to go down?
Right. I mean, what I would say is by positioning in cash and being able to do that, you give yourself optionality. You give yourself the ability to have leveraged purchasing power in the future. So positioning in cash now is the opportunity to buy a lot more later. What I would say is that in this environment of desperate monetary policies and governments who are willing to spend anything to keep people happy. I mean, keep in mind, COVID reintroduced the world. This is something that's very different. We haven't seen this since the 1960s and 70s. Governments around the world rediscovered that it's really fun to put money in people's pockets. It makes you very, very popular as a politician. Ash, I'm sending you $10,000. What do you think of me today? Don't forget to vote in November. Don't forget to vote in November. So we've rediscovered the power of the purse. This is fiscal policy through COVID. We've got Build Back Better. There'll be a dozen other things over the next decade, which are huge trillion-dollar spends. That means that your cash is at risk too, because inflation is here to stay. Even though the supply chain issues go away when we sort out who we're buying our microchips from. That'll all sort itself out. But what's not going away is government spending money that they don't have, and that having an inflationary impact. We went from sub 2% inflation, now the official CPI is 7%, right? So I'm saying move to cash. How can I in good conscience say move to cash when it's a guaranteed loss of 7% sitting in a bank?
Well, how can you do that?
Well, what I would say is that's why we launched our vaulted program. Our vaulted program is a cash equivalent. It's meant to substitute for a bank or savings account, but it's denominated in ounces, held with the Royal Canadian Mint in Ottawa on your smartphone, on your computer platform. If you go to the App Store and look at Vaulted, or go online to vaulted.com, it's a brilliant program. It's a cash equivalency, very compressed cost to buy and to sell, instant liquidity. And it's designed to be what gold was for 5,000 years, not a commodity that you speculate on prices up and down. It's the basis of a monetary system. And if we're not going to be on a gold standard as a country, you can put yourself on your own gold standard. Insulate yourself from the costs of inflation by having a part of your liquidity in something that protects you from the ravages of inflation. So yes, you want to reduce your market risk in real estate. Yes, you want to have some exposure to cash, or I would say a cash equivalent, and you can get that in ounces. Vaulted's a great outlet. There's others, I'm sure, too, but that would be the way I would solve the inflation problem and the overexposure problem to real estate. I'm a huge bull in real estate. I own real estate personally. I own investment real estate. I am dying to get out of ounces and into more cash flowing real estate. Okay, so this is not the gold guy who's anti-real estate. I'm pro real estate. I just want to own more of it on the best terms possible. And I think that given the market structure and the fever pitch speculation that we've seen in cryptocurrencies, in non-fungible tokens, in meme stocks, I mean, you've got money flowing and people are excited and people are making money, and it's in real estate and it's in every asset class. Ash, I just don't think this ends well. I don't think this ends well. The good news is it ends really well for someone who's like, yeah, I think I'm just going to take a few of my marbles out of the game and I'll put them right back in. But I want to see, instead of 3 marbles buy 3 things, I want to see 3 marbles buy 9 things. Increase your purchasing power. Let the market come to you. Make money on the buy side, not when you sell.
David, you've made a really compelling argument about what's on the horizon. Why would you not take your father's advice and sell all your real estate now?
A couple of things. Number one, my real estate's not leveraged. And number two, I've got really good visibility on the rents. And so, it's a very strong position to be in. Okay. And I remember one of our other clients who, at one point had, close to 1,000 apartment rental, 1,000 doors in downtown San Francisco. And he leapfrogged from 500 to about 1,000 in one of the many economic downturns we've had in the last 60, 70 years. This is a guy who's dead now. He's dead now. He retired to Spokane, made a ton of money building houses in the 1930s, made a ton of money in the poultry business in California in the 1950s and 60s, built a real estate empire in the 70s and 80s. And what he told me about what he built in terms of a real estate empire in San Francisco, not a bad place to own 1,000 doors, I would think, is that when the market turned down, he had zero debt. And everybody that's around him was scrambling to make payments while he just lowered his rent 30% and stayed 100% of capacity. Meanwhile, building A, B, and C across the street are going back to the bank. And that's how he jumped from 500 to 1,000 doors pretty quick. He had staying power. He had the ability to lower his rents to whatever, to keep it 100% full. Put him in a huge position of strength. And his kids always looked back and was like, Dad, teach us how you made money in real estate. This is amazing. All he could say, and this was my last conversation with him, was in 2002. Gold was at about $400 an ounce. It's $1,800 today. He said, my kids will never get it. It's not about real estate. It's about understanding value. It's about buying things right. And so what he was doing, he actually had moved almost 100% of his money into gold at the time.
Yeah, but how does gold compete with NFTs and meme stocks and syndications and growing money? And I mean, these coins, your money's growing, you can watch it. There's nothing fun about gold. And how do you convince people that that's the right way to go?
Well, I mean, I think there's a difference between something that is fun and something that has had a meaningful existence for 5,000 years. I mean, if you think about the rise and fall of nations, if you think about the history of the world, and even the fact that we have the opportunity to buy real estate on leverage, the basis of all banking, the basis of all money has been for 5,000 years gold. I mean, we're playing games now with fiat currency that has nothing backing it, but the longer history of gold is just money. So you're interested in money. I'm interested in money. You're interested in non-fungible tokens, cryptocurrencies, and syndications because it represents more money to your balance sheet and income statement in the future, which means you should have an interest in gold because gold is nothing but money. It's just what money has always been versus what it is today. I'm interested in more money, which to me translates as more ounces, more ounces. Now I'm going to get to more ounces through understanding relationships and relative values between asset classes. Today, the relative relationship between stocks and gold favors getting out of stocks and getting into gold. Why? So I can come back into stocks when stocks are cheap and gold's expensive. I don't care about ounces, actually. I'm improving my position by moving laterally from one asset class to the next. And yes, I'm interested in syndications. Yes, I'm interested in real estate. I'm probably not interested. I'm not your guy for cryptocurrencies and non-fungible tokens because I don't know what they are. And maybe you can tell me what they are. But yeah.
Yeah, I'm like you. We're still trying to figure it out.
Yeah,
But
so
it's
you can
fear of
categorize
missing
them.
out.
It's fear of missing out.
Yeah.
It's I can't believe somebody made $1 million and they made it in how fast. I mean, so there is a sense of sort of irrational exuberance when it comes to those things. Whereas if you look at real estate, the reason you like real estate is because it's a tangible asset. You can stub your toe on it, you can walk around it, you can get comps in terms of what this thing is worth, and then know if you're getting a good deal or not a good deal. And you can look at the cash flow attached to it and be like, gosh, this is fun. This is fun. I look at gold and I say, it's actually really fun because all you're doing is playing a game. You're playing a game. For me, I may be in gold today so that I can be in acres tomorrow.
Yeah.
And I care about that relationship.
It was brilliant with Vaulted where you can just swipe and buy gold.
Yeah, I think it's, we're moving into a digital era, certainly. And gold is stuck in the 19th century, certainly. So Vaulted is how you bridge all the integrity of 5,000 years with the innovations and convenience of the 21st century. So you get the benefits of something that has been enduring wealth through millennia, but you're not hampered by somebody delivering a package to your front door from the US Postal Service, or God forbid, a FedEx driver leaving $50,000 worth of gold on your doorstep without a signature. I mean, to us, Vaulted is a great way to own an incredibly valuable asset, to protect yourself against inflation, to have some upside in the case of market downside, because they do tend to move in opposite directions. If stocks go down over the next 2-3 years, gold's going up. No question. No question. So you've got some upside.
And David, what's the markup? How much more am I paying per ounce if I buy through Vaulted?
Yeah, 1.8% is the transaction cost to buy or sell gold through Vaulted. The beauty of Vaulted is we have an arrangement with the Royal Canadian Mint. We're sourcing our bars directly from them. There is no wholesale middleman. We're getting the bars as cheap as you can get them. So it's your melt value plus 1.8%. You can look, I mean, there's actually other people I know in the industry are like, oh, we only charge 1%. Yeah, off of a much higher base. Off of a much higher base. We are one of the most, if not the most affordable way of buying gold. And the beauty is you don't have to buy an entire bar. You can buy $5 worth, you can buy $20 worth, you can buy $1,000 worth. I mean, we have clients that have bought multiple millions of dollars in the Vaulted program. And it's been particularly popular with people who are looking for a short-term repository for their wealth. You sell a real estate deal, it's going to be put back into the market. You're going to be hanging out for 6-12 months. And you don't like what the dollar's doing and you don't want it in the bank. Maybe you don't have a great relationship with your banker. They certainly aren't paying you much.
David, taking into account or discounting today's economic climate, what is your best real estate investing advice ever?
My best real estate investing advice ever. I go back to that example of the Plaza Hotel in the 1930s. And I think, buy when no one else is buying and sell when everyone is interested in buying. And it's a contrarian model, and it's really hard to do because, again, there's the issue of fear of missing out. There's the issue of, what does someone else know that I don't know? So how confidently are you engaged in the investment process? And it's a lot easier to look around and say, everybody's doing it, everybody's making money, I'm just on board. But to be able to buy when no one's showing up and sell when everyone's there just begging for the opportunity to own it, it applies across asset classes. But I can't tell you the number of times we've seen it even in our own industry. I remember, this goes back, again, we've been in business for 50 years. We had a doctor call, this was the early days, 1979. Silver's at $50 an ounce. It's just gone from $1 to $50. That's silver, right? So there is upside. There is a lot of activity and a lot of things to be gained in having long exposure to precious metals. But my mom takes the call from a doctor. We're a small business at the time. Doctor says, I want 2 bags of junk silver. She's like, I don't think you should do this. You're paying the highest price silver has ever been. Why don't you wait 6 months and see? He's like, excuse me, I have an MD behind my name. I think I know what I'm doing here. She could not hold him back. And, he went on to lose 80% of his money. Why? Because there's volatility in any asset class. And he bought at the absolute peak, which we didn't see again until 2011, right? So where you buy does make sense. And if everybody's clamoring to put money to work, take your time. Take your time. Everybody wants to move their personal balance sheet ahead as fast as possible. If you've got $1 million in assets, do you want it to be 10? If you've got $100,000 in assets, do you want it to be $1 million? And you want to close the time gap to make that happen as fast as possible. Leverage gives you that opportunity, but leverage gives, leverage also takes away. And I think that's the problem, is if you're overpaying for an asset to begin with, and it's on leverage, you can find yourself in a world of hurt. I think the best advice I could give is, in this environment, probably just want to cool your jets. Probably just want to cool your jets. And that's not because you're any less strategic in wanting to grow your wealth in real estate. It's because you're more strategic than the next guy. And you want the best price possible because that's how money is made. The price you pay, not what you sell it for.
David, are you ready for the best ever lightning round?
Hey, I don't know what that means, but sure.
All right. You're about to find out. David, what's the best ever book you recently read?
Best book I recently read. I have to sort it through. I'm reading a novel by Jean Le Carré, and I've got to get out of my head, which is sometimes tough for me to do. And a spy novel it's perfect. It's a complete distraction. So I'm actually in the middle of a Jean Le Carré novel, and it's fabulous.
And David, how can the best ever listeners reach out to you?
If they're interested in the Vaulted program, Vaulted is on the App Store for either platforms, or you can go to vaulted.com online. Keeping in touch on a regular basis. In March, we go into our 15th year of a weekly podcast on all things financial. So if you want an education, if you want a deep dive into the deep end of the pool on economics and finance and geopolitics, that's where you'll find us, at weeklycommentary.com, weeklycommentary.com. You can do some binge listening, and I doubt you'll ever catch up because we're solidly 14 years in.
David, thank you for an incredible conversation today. The contrarian advice that you've given is refreshing. A lot of us older guys have seen market cycles, but there's an entire generation that is not. So this is very refreshing advice, very contrarian to everything we're bombarded with on all of our real estate social media, our real estate news sites, and really what everyone's telling us. So this was a great dose of reality.
Ash, thanks for having me on the program. I really have found in this period of sort of political volatility and hypersensitivity, I found myself gravitating towards country music as almost like, a good dog, and a good beer, and a good pickup truck. Let's just go back to the basics. But a song rings in the back of my mind. You got to know when to hold them. You got to know when to fold them. You got to know when to walk away. You got to know when to run. And it's not that you're any less bullish in real estate or have less of a strategy. It just means that if you know how to engage even more strategically, the benefits are going to accrue to you that much faster. And you're not going to be forced into a place where you're playing the patience game.
Yeah. Again, thank you. Best ever listeners, thank you so much for joining us. If you enjoyed this episode, please leave us a 5-star review, share this podcast with anyone you think can benefit from it, and follow and subscribe. Have a best ever day.